Hello and welcome to the Friday edition of the Market Update. So, hope you had an amazing week. Well, right now it's a guessing game with interest rates. So, there is no clear indication if rates are going to go up or down. And there is now some chatter that rates will actually go up. So, what's up with that? We'll get into that in just a little bit. But the economic indicators that primarily drive interest rates are one, inflation, and two, jobs. And the core personal consumption expenditure, PCE, which is the Fed's favorite indicator of inflation, came out today and it was pretty much flat, 2.8%. Nothing changed. But the Fed's target is 2%, and we're a ways away from that. Now, it is being extremely stubborn and not making a lot of progress. So, why would rates go up? The challenge is how the PCE inflation is calculated. It is essentially a rolling 12-month average where they take month over month readings and they add it all up together. So, in other words, they add up each month over month figure. So, the April 2024 figure that just came out today replaced the April 2023 figure. So, the challenge right now is looking ahead to the rest of the year. We will be replacing some very low numbers throughout the rest of the year. And that could actually, if you look at some very conservative numbers, move inflation up to over 3% by the end of this year, which that doesn't help our interest rates. So the other driver that could impact rates is the job market. If the job market starts to falter and less jobs are created, the unemployment rate will definitely rise. And they don't want that to go over 4.2%. The Fed basically has a mandate to look at inflation and employment and try and keep them in this range so that the economy stays strong. So when jobs are lost, people just simply spend less money. Even those who have jobs, because they're fearful that they could potentially lose their job in the future. So it's really important for the Fed to monitor the job market and see and make sure that it is definitely cranking along. If it starts to show cracks, the Feds could potentially start to lower the Fed funds rate, which would lead to definitely lower mortgage rates. And they want to protect that job market from going into a tailspin. So jobs data comes out next week. So we'll be watching very closely to see how strong it is. Now, one wild card that is out there is whether the U.S. government will step in and start propping up the mortgage-backed securities market, MBS. And that would be by buying mortgage bonds. They're definitely going to start running off their balance sheet, which is another big term we won't get into today. But they indicated this will start in June. So cross your fingers. Hopefully that will keep rates at least stable and potentially move downward. So despite the persistently high interest rates, property values just continue to increase. The FHFA, Federal Housing Finance Agency, released their house price index, which measures appreciation on single family homes with conforming loan amounts. And it showed a year over year increase in March of 6.7%. Now that's nationwide. Las Vegas is still strong as well. So buyers waiting for a crash. I hear this a lot. Oh, the market's going to crash. Values are going to go way down. They're going to be waiting for a long time. And if they're waiting for interest rates to drop, they still could be waiting a long time. People need to move. People have things to do, and they don't want to stay stagnant. Keep educating your buyers and sellers to alleviate the fear of making the right decision. Indecision, technically, it leads to no decision. They just freeze. They don't make any decision. So keep them informed on what's going on in the market. And if they know what they are getting into and understand the dynamics of our current real estate market, they can go in with their eyes wide open and be prepared for the long run. They know what they're getting into. They know they might have to pay a little bit of a premium on their mortgage payment right now, but long term, they could potentially lower that interest rate and their mortgage payment. So as always, feel free to reach out to me directly to get your buyers pre-approved and educated so that they can make the right decision for them. You can also send them to my calendar link where I will go through a free CIA analysis, credit income asset analysis, which is technically a snapshot, financial snapshot of where they stand right now and what they would need to do to get into a home. So let's run their numbers and get them into a home and start building wealth for themselves. Hope you have an amazing weekend, and we'll see you next week. This is Gaylord out. Bye, everybody.